Hi guys, I'm Henry Zitzman from Amazon Web Services. I look after startup programs across Africa. One thing that you always should realize is that funding and VC funding and angel funding is all mechanisms to help you scale and grow and so on. So today what I would like to do is do a Q&A with a gentleman that I think he should introduce himself, Stuart van der Veen. But just before he does that, because he can talk for hours, I just want to say that this gentleman is extremely influential in the market. He's been in startups, he's been in Nedbank, corporate banking, investment. He's working in a venture firm called Paperplane Ventures. He's also now part of a scale out with a startup on AWS called Aerobotics, moving around. So it's really a privilege to have you here. Stuart, before we, as we start, could you give me a bit of background from yourself? Tell us about your journey. How did you get to this position? That'll be really great.
Yeah, sure. Just
Cool.
I think quickly, how's everybody doing? How the last few days been? Intense? Kinda. Oh, good. So Stuart van der Veen. I founded a venture capital firm in 2014. And I think the essence of Paperplane Ventures was essentially that we didn't have anything, right? So how could we create something from nothing? And we started off doing basic advisory work in the space, came out of Deloitte before that. How do you use a sprat to catch a mackerel? We started making small investments. One of them was Click to Sure, and we got a decent valuation bump when they were funded by Greenlight RE, which is a NASDAQ listed reinsurer, and Centbee when they were funded by N-Chain, in kind of the Bitcoin Satoshi version community. In 2016, we started working with a larger funder that focused on infrastructure called Platform Investment Partners. And they were founding shareholders of Vumatel and Dark Fiber Africa. And we found a really great niche in terms of investing in analytics companies that could leverage these infrastructure competitive advantages. We started to get quite bullish in the space, and we're fortunate enough to bring on teams that were willing to back us. We brought in an institutional investor, and we allocated capital. And then in 2018, we landed up exiting to a European corporate, one of our investments, and what was one of Africa's largest tech deals. Which was pretty awesome and really put us on the map. So we had this track record with Platform Investment Partners, which essentially absorbed the firm, with Vumatel and Dark Fiber Africa, essentially exiting majority to CIVH, controlled by Remgro, and then also exiting one of our key assets in a pretty significant and almost like a milestone tech event. Which kind of threw us onto the map a bit. In the meantime, I also assisted Nedbank Corporate Investment Banking establish their venture capital fund, and also worked with them in terms of commercializing their investments across their client base. So how could you start to build industry analytics platforms? And that's essentially what we worked on doing. So just in a nutshell.
Yes, I think I'd like to approach the next question just to paint a picture that the journey for a startup can start with angel investment. It can also still be in bootstrap phase, so you keep ownership of your assets, right? But at some point you want to scale, and there's a few options out there. Why I really wanted to have a chat with Stuart as well is because he's been in the corporate VC side. And also I would say, in Paperplane's early stage VC as well, right? So what is the differences in the value proposition? Because both institutions has invested in Aerobotics, the same startup, right? So he was on the one side of Nedbank Corporate VC doing this investment, and then on the other side from Paperplane Ventures. Maybe you can tell me a little bit about that value proposition.
Yeah, so I think from a corporate VC side, it's very much, is there strategic alignment for the business? And the key thing that I learned there was if you can find that alignment, it just goes so much smoother and so much quicker. I think a lot of the time, especially myself, like I was flogging dead horses a lot of the time, trying to get things to move. And until I learned that if I didn't align with the business in terms of what they were trying to achieve. So for example, with aerobotics, there was a key strategic imperative to win market share in export crops. Farmers in South Africa have moved from field crops into tree crops, which are ultimately export crops. And it creates an opportunity to actually be able to win market share. It's quite a unique event. And so once I found alignment with that and we started doing experiments in the early days with aerobotics, the hook just caught and it went quickly. We did an initial experimentation with a Pekin client, and the feedback was really good. In that meeting, they tried to sign a commercial agreement with aerobotics and get exclusivity for a region. So we immediately knew that we were onto something here. Aerobotics still had a long way to go in terms of operationalizing scale and understanding what that meant. So I would definitely say that's the key piece for corporate VC, whereas for earlier stage VC, they very much look at, what have the teams done before? What is the quality of the management? Do you need to supplement that? How defensible is the idea? If somebody flips a switch who's got scale, are they going to kill you? What is your competitive advantage? How defensible is your kind of your IP? And these are kind of the main considerations there. Especially because in corporate VC, they're typically large clients that you can de-risk with, whereas in earlier stage VC, that doesn't necessarily exist. And I think it's a critical skill set that startups should be looking for in investors and partners. All money is not equal. I think if money brings clients and money brings the opportunity to actually commercialize and find that product market fit, it's much more valuable. And even if it's post that in terms of earning revenue, do they bring additional clients? And are they influential in the market and the industry that you're operating in? So I think those are kind of the key differences there. If that makes sense. And I mean, I'm happy to talk through that more if you'd like to iron anything out or chat about it.
One clarification.
Yes, yeah, sure.
Can you define early stage VC and late stage VC, especially from a financial perspective?
Yeah, sure.
So he has 100 million as a 10.
Yeah, sure. So I think let's start even earlier, right? So you've got your kind of your angel networks and communities, and I'm speaking very vaguely here because they can't. Sorry. Oh yes, that is a big problem.
Early stage, right? Awesome.
How early?
Pre-launch.
Pre-launch.
We're building our meeting now.
Oh, cool.
Great stuff.
Okay.
Awesome.
Just okay.
Josie.
No answer. So
Sorry.
yeah. So I think angel networks are doing great work, but I think even better than that are people inside of your own network, and even to the point, I wouldn't say harassing, but like really taking them on the journey with you and letting them build trust in you, and actually validating that you're in this, you're not fly by night, and that you've got the grit to actually go through with it, because it's one of the most painful experiences of a person's life, Like the people who go and do it a second and third time, you're like, there's something wrong with this person. And in fact, they're like the most valuable people because you know that they've got the grit that's been validated. And when the chips are down, they don't walk away. So yeah, let's go. Angel, right? I mean, anything from a couple of $1,000 up to a couple million. Earlier stage VC, I mean, if we're talking pre-revenue, I doubt pre-product market fit. Unless there's something extraordinary about that team, I'd say from maybe like a couple 100,000 through to kind of your 10 million rand, and then I'd say your larger VC. I mean, it's still tiny compared to global VC, but for them to write a check less than 10 million rand doesn't really make sense because they're operating on they've got professional legal services and advice. They want to make sure that they've got their preemptive rights in place. They want to make sure that the agreements are rock solid and protected the downside, and that they're incentivizing the team on the upside. So you've got to do like really smart structuring around that. So I often see like checks tabled with us that are for sub 10, and it's almost like if you're operating in that space, that category no longer makes sense, but it's so important, right? And so it's also the life stage that the VC's in. So finding that right VC team that you believe also is going to evolve into a juggernaut, right? I mean, I was reading Wired magazine this month, and you're looking at it's like SoftBank, and it's like Apple and like Uber, and basically Yahoo, like basically everything that's defined tech in this generation. But when they invested in these companies, you know, these guys were flying around the world like winging it. And they kind of followed their gut sense. They had incredible vision. But they became that because they grew, and the companies grew behind them as they allocated more capital and actually started to win. So that's why I say not all money is equal.
So there are early stage VCs around?
Yeah, increasingly. Yeah. And I think you're going to start to see a lot more.
I think let's go into this question about the angel networks, right? So Africa Business Angel Network exists. It's an organization. There's 66 of these angel networks out there. The way I try and meet startups is through angels at accelerators, VCs, incubators, as well as PE firms, private equity firms. To get into the network, like you said on Josie Angel, it's probably not going to happen that easy. It has to probably be an introduction. To meet some of these angels as well, it would be really good if you go to the SAFCA events, South Africa Venture Capital Association events, or also startup events. Yeah, exactly. So that is the way that a startup can get going, but you're not going to immediately get the funding. And I think we're going to go a little bit now back to the point of a VC investment. So Stuart, paper plane ventures.
Yeah.
What are you guys invested?
So I think I'm going to talk about it at the group at large, right? So there's that infrastructure piece that I mentioned, and we like infrastructure because we've got very strong competency and track record in it, and it brings competitive advantage. On the technology side, we mostly focus on software and analytics, and if it's something that we believe can operationalize and scale on South Africa continent and ultimately globally.
So when is a good time to connect with paper plane ventures for a startup?
Yeah, when you've got your focus, right? Like often we'll have meetings with teams and they come back 6 months later and they're doing like something completely different.
A pivot.
Yeah, but it's like it's swapping industries,
All right, cool.
And that like freaks us out a bit.
Yeah.
Because there's nothing wrong with a pivot, in terms of finding product market fit. But when somebody comes and sees us and they're doing like 3 or 4 startups at once, like that just freaks us out.
Yeah.
Okay. And what we do like is if they've augmented the skill sets that they're missing, and they're experienced and kind of self-aware enough to realize that. Cool. And they're able to bring in, a technical co-founder, a very commercial savvy co-founder, and whatever other skill sets you need for that particular industry and some of that experience.
So in my own journey, I also try to get my own startups going. Lovely stuff. It's really hard work, and you go and you decide that you're going to get a VC to invest in you. And you don't have any revenue. Nobody's told you it's not the right time to do it. You don't have sales. Your product's not right. Your pitch is not ready. And that's the kind of stuff that happens. And you start reaching out to VCs and click on the button, fill in the form. And you're lucky. Angel Hub Ventures maybe replies, says, "Your crap idea, go away." Or Knife Capital says, "Who the hell are you? I don't even know you." All right. So let's ask Stuart. Stuart, what is the best way to connect with a VC?
So I mean, like for example, for us, every communication that comes through to us, whether it's through our website or whatever, like we see and we read and we consider. So we have a deal forum every Monday morning, and we work through anything that we've received.
How many do you work for, as an example?
I mean, it could be 10 to 15 a week.
Sure.
That's kind of the deal flow that we're seeing at the moment. Yeah. But I think we try to provide feedback in terms of why we do or don't like it. It may take us a little bit of time just because we're trying to work through quite a bit of volume and we're a relatively small team. But we do try to give that feedback. I wouldn't say they're unhappy people. I mean, often we say, let's keep in touch, please keep sending us updates. And that's what I spoke to about building this relationship early, and also your credibility in the market space. And it can take like a long time to build that type of credibility and that trust and that reputation. And this is where like things that you may have done in the past, you may want to go settle, because if something has happened in the past and that happens to be the person who one of the team contacts to chat about, and they're like, the person's a real gem. It immediately creates an uncertainty, because often where there's smoke, there's fire. And so I think it's important to settle any scores you may have in the ecosystem when you're considering going into this, and really remaining focused, and making sure that you're taking people on that journey and crafting the narrative that they're going to see as value creating.
Yeah.
I think often, like, a lot of companies come and talk to us and they're trying to solve, I mean, it's important to have a vision, but they're trying to solve non-commercial problems, right? And they haven't really considered the size of the market or the opportunity, right? Like, if you clock South Africa, it's a small market. If you clock South Africa, what is the real upside here? And how is there possibly an exit? If there's no exit, there's no deal, right? I mean, that's the way people who are looking for venture returns think about this stuff. So it's important when you've got a savvy team that they've considered stuff like this. And you can very quickly see it when you look at a deck, whether they've got the right advisors who've given them input like that. And you can see that they're thinking about it in a commercial way. You know, there are very few VCs, maybe the guys chasing the sustainable development goals, or some of the impact funds, even they have monetary requirements that they need to meet. Those are their objectives and key results that they need to achieve. And often we don't see that coming through in a deck. Sometimes numbers are just not even mentioned. And then, this is more like reading a storybook or a picture book than anything that's meaningful for a VC. Often people will send us their product deck, which is nice to look at, but it gives us no insight into what is actually happening in the business, even if their revenue is only like 1,000 Rand, right? I mean, if your revenue is 1,000 Rand, somebody's buying it, there must be some sort of product market fit. Like, it's a good signal. It's better than no financial information. And so we like honesty and we like to follow that story. If that 1,000 Rand over a period of 6 months grows into monthly recurring revenue of, I don't know, like 100,000 Rand, like, that's an impressive growth story, right, for like an early stage company. And we want to see that. Also because when we receive something, we kind of peg a growth trajectory, and if they then beat that in our minds, we're like, wow, there's something to watch here. Who are these people, and how can we spend a bit more time with them to understand? Also for us, it's important to do like a whole bunch of introductions into our networks to see if the team can actually deliver on what's being required. How professional were they in terms of getting their proposals out? Did their proposals actually meet the specific needs? Could they align with the business strategic imperatives, if it's B2B, for example? And if that comes back very positive, that's just another tick, another signal for us to follow. And it demonstrates as much as it demonstrates value to us, it demonstrates value to the startup that we're going to be value-add partners, right? Yeah.
So let's say the entrepreneur has a really bad idea. How do you feed that back? Do you feed that back? Do you think it's important to feed that back to the entrepreneur? I mean, how do you manage that?
Geez, things I thought that were terrible have gone on to do really well. So I don't think that that's my place to tell somebody that they've got a bad idea. If we can talk through it in terms of a discussion and size the market, from where my competencies sit, like, I'm happy to work through from that perspective, and for us to come to the realization, that maybe this needs to be adapted in a way, and to think about it in a more strategic way, right? How can you create competitive
so that's kind of like
advantage?
adding value immediately into that pitch, into that proposal from the startup, guiding them in terms of a little bit of direction.
Yeah, like, I'd never say this is a cuck idea.
Your kid does.
Yeah, that's the style.
Exactly, fantastic. So what are other things that you look at? I mean, you mentioned team. It's not just startup, right? It's not just one person. Tell us, why is a team something that you would rather go for than an individual entrepreneur trying to do everything himself?
Individuals aren't scalable, so having a team already shows that you can work in that dynamic.
Exactly. Yeah.
And that you are self-aware enough to realize where you're not competent and how you can augment that. And I think if you can build a small team, you can, we hope you can build a big team.
Yeah.
Often when companies are going through scaling, they need to almost turn themselves into divisions, which is detrimental when they're a big company because now they're siloed. So how are people thinking through these problems early on? And it's important, you can think, right, that's going to be a good problem to have when this is a huge company. But if you're not thinking about that early on, even about how you structure your business and how sophisticated you are in terms of that thinking, it's a negative indicator to investors. So I think it is important to consider all of that. It also shows how seriously you're taking yourself.
So one of the things that happens with startups, you get really invested in your own time and your own effort. You're very positive. It's your idea. It's really cool. You actually don't. Quite a few of the startups don't have enough data to go through your, call it a due diligence process. Tell us about the due diligence process as a means to help entrepreneurs and startups build up that engagement tactic with you.
Yeah.
So what is all that?
I think engaging with investors can be very onerous, and it can be very expensive in the sense that it consumes founders and team members' time. They have to prepare information that's been requested. They have to create a data room, and there'll be literally hundreds of requests. There can be hundreds of requests. As VC teams go through this process of establishing how defensible an idea is and what the size of the opportunity is, and even if those two are ticked, is this the right team that's going to do it? Right? If there are 10 teams in the world working on this, is this the team that's going to win, or is this the team that's going to be one of the teams that wins? And I think that entire process can be incredibly emotionally draining, right? You go through highs and lows where you think you're invincible, and the next moment you're dead. And it's about managing that process and not letting it be detrimental to achieving your targets, right? The more revenue you earn, the more profitability you can squeeze out of it, the better valuation you're going to get, the less you're going to get diluted, the more incentive you're going to have. If you find the right partners who are further going to incentivize you, those are the types of guys you want, and that can be a very onerous process to go through. So I wouldn't start that process too early, beyond taking people on the journey with you and only raising, from I guess a venture capital, either early stage or when the time is right, and rather working with angel communities in the early days, because that money flows. It can come and sit as a loan, and you can convert it later on when there's a valuation pegged.
Good point.
Yeah, so that's, and also it's a great indicator that people have vetted your business with their money, right? And if you can identify some influential angels in that industry, and they're committed, that's a massive positive. And their money comes a lot quicker. It's less onerous. Sometimes people really want this credibility of big VCs, and unless it's an enormous check size, 10, 20, 30, 40 million US dollars, I wouldn't want those names, because they wouldn't have enough skin in the game for us to matter. I would rather have a team that is, this check is significant enough that they're actually going to put effort in to help us commercialize, right?
True. So I recently visited an incubator called Launch Lab, and they've got an extremely structured approach in building up what we call a pitch deck, if you think of that, right? It covers, for example, product fit, market fit, legal, IPR, HR, how do you scale, everything like that. It would be really good for a startup to go through these kind of pitch decks, which is really downloadable and seen everywhere, and actually try and fill out as far as you can that picture where you want to be, and then track yourself against that growth towards that. Because when you are going to engage with a VC firm, for sure, you will have to put numbers down, and just doing that on the last minute is not going to be a very positive experience, right? I think, Stuart, your advice here about getting also referenceable angels, for example, is a really great idea, because it shows there's skin in the game as well. So Stuart, just one thing. I see that you've won a London award. What was that about?
So the Banker Tech Projects Award is from Financial Times, and it's pretty admirable in the banking world. So my team and I at Nedbank commercialized aerobotics across a pretty large cooperative in South Africa. That was very commercially successful.
So what did they do? The bankers all pitch up with ideas, and they go, look,
so you're nominated for it?
Yeah, exactly. Yeah.
And the citation there
well done.
was one of the most successful and imaginative fintech partnerships in the world.
Yeah.
And we went up against Goldman Sachs and that.
Sure.
We went up against Credit Suisse.
That's impressive.
And we won that. So we're incredibly proud of that. But awards aren't what's important. Tangible results are what's important. And I mean, I think because we focused on that, like this was a nice validation of what we were doing, but it wasn't the be all and end all. But yeah, it did feel good to get some validation.
No, exactly. I think that's also a very good thing to have. For startups to get validation as well, that's something that's important for founders to keep that energy going as well. So you get awards like Global Startups Award as running locally and so on. It's really worthwhile applying to these. You get other events like Africa Arena down in Cape Town that actually help you into the scale, meeting other VCs that you mentioned, property investment kind of stuff. Behind all of that, there's usually some sort of a corporate investment, right? So you're going for different tracks. That's my part of it. My advice for early stage startups is to look at all these awards and events and do take it. Some of them are actually free, and you learn a lot from that. So what else would you, what would you advise an early stage startup to do? Just got their minimum viable product going, launched. I mean, what other advice would you do? Is it so important to get funding in that early stage?
I think the most important thing to think about is what makes us defensible, right? Why can I not be killed tomorrow? What is that moat that protects me? Is it intellectual property? Is it the amount of data that we're getting? Is this so unique that it's a specific skill set we have? Is it through partnerships that we've locked in, which means that pipe's closed to anybody else in an exclusive way? And I think the more strategically you can think about that and prepare it early on, the quicker you're going to create value. And secondly, the most important thing is get revenue, right? And preferably monthly recurring revenue. So
it's in a way, it's a case of saying, get to market as fast as possible, validate your idea, reiterate, redo, move forward, and continue in that process to just ensure that you get that lock-in that you need for a revenue point of view, right? But I mean, what if your startup stay non-profitable for quite a long stage, right? What do they do in that kind of stage? I mean, where would do they get funding? How do they treat that dip, as you want to say, before profit?
So, I mean, it's a terrible analogy, but I'm going to use it anyway. Like, I think a lot of startups, like, imagine VCs being like your parents, right? They try date their parents, and go get out there and actually validate what you're doing, and go prove what it is you're trying to do, and find those right partners to do it, find that product fit, and then.
I think the validation point is very good.
Yeah, I think
that's a really good.
I think if money is what you need right now, I don't think you're going to make it. Then you're better off going and sitting in a corporate and saving up until you're ready to do this. I think starting out with a little bit of a nest egg is like a great way to do it, and with the right experience in an industry. And then, first of all, starting with advisors in that industry who can fast track your understanding of it and help you identify these strategic imperatives.
You mean like mentors or something like that?
Yeah, even if it's in a mentor. I mean, a good example for us, right? I mean, in our early days, we sent an email out to Chris Becker, who said we're looking for an advisor, and he was such a legend. He wrote back, he was like, guys, this is awesome what you're doing. Don't stop. But I'm sure you can imagine as I'm scaling Tencent and Naspers at the same time, my time's a little bit tight.
But the worst thing that could have happened, you could say no in a nice way,
exactly.
right? And if you said yes, then it's great. And mentors are around, so you can find other startup mentors. You can look at the accelerators, mentor networks. Find yourself mentors that will actually share time.
And mentors that are going to add value and be another tick in your box, right?
For validation
this person
as well.
knows what they're doing. Often we'll receive a deck and there's some advisors listed there. And make sure it's an advisor, you don't just list it there, because the first thing we do is phone that advisor and be like, are you involved? And if it's no, the deck goes straight in the bin. I think it's a massive tick if you've got people that are respected in the industry that understand it, and you've been able to bring them on board, and that they've allocated time to what you're doing.
Yeah, that's great. Yeah.
I think that that's awesome. And then also, once you build a relationship with you and they're on this journey and they come to trust you, they're often the best source of like angel funding, right?
True. Or introductions to angel funding.
Or introductions to
Exactly.
angel funding, right? Because they've got extensive networks.
True.
And that's where we've seen like the teams that have been the most successful in this. That's typically the way they've done it. And then once you make it through kind of that angel phase and you've got this fit and you're bumping that revenue up, then it's time to start engaging, properly with VCs. Unless it's something so extraordinary that the opportunities,
It's just
grotesque and disgusting, and they're gonna plow money in early. But it's really unlikely. It's more unlikely than it is likely that that's gonna happen.
I think So let's talk about the VC scenario. So you've got Johannesburg, Cape Town, where we are now, right? I mean, obviously there's VCs everywhere in the world, Tel Aviv, New York, whatever. Let's talk about Cape Town and Johannesburg. What is the difference between Johannesburg VC scene, let's say from 3 years back to now, and how do you see it develop in this market?
So I love Cape Town ecosystem. I think one of the problems here is access to corporates. So teams often sell out and start doing consulting work, as opposed to focusing on their product. In Johannesburg, I mean, there've been some really cool companies coming out of here recently, and I think the Johannesburg ecosystem outside of the corporate front is behind where Cape Town is. I think Cape Town's unique in its lifestyle benefits and in its natural beauty. I think that's where people want to live, and especially very talented people. So I think it's easier to find talent there on the engineering and development side. That's what we've seen, and I mean, you guys are building big facilities there. I love the talent that came out of some of the big science projects like SKA in South Africa.
Exactly.
Some really cool computer vision skill sets came out of there.
Good.
And so when we see that in a team, it's
That's really good.
It gets us interested.
So I think that's a good point. It re-emphasizes the importance of a single founder is going to have a tough journey going forward, and a partnered team is something that is really highly valued. Bringing in mentors is free, and you should use that as a means to get access to the right network that might move you into the right direction going forward, right? So I think that's what I want to wrap up with today. You have a question, sir?
When you're done.
Oh, okay, cool. So I just want to say thank you to Stuart for joining us today here on the Q&A. And
Sure.
thank you very much.
Thanks,
Congrats for your next
absolutely.
reward. Can't want to wait for the next award, right?
I don't want awards, I want results.
There we go. Cool. You guys can connect.
Stuart, thanks for that. This was one of the best Q&As I've had on startups, so thank you very much. But I actually have two sides of this question that I think we should
Sure.
shed some light on. So I'll get to this quickly. We do a lot of tech work with Integrate E-Squared Foundation.
Cool.
Time, etc. All of those. And there's this one little area, and this is quite a personal thing that I'm trying to deal with, is there seems to be this perception around VCs, right? Going, well, there's no angel funding, and there are people who that's great, but you need to get a VC involved. And there's this perception within startups that when a VC gets in on the game, they tell you exactly what you do, they're going to throw some people in, they're going to try and accommodate, they're going to almost push you a little into a direction that's not necessarily where you want to go. Is that a real concern? Does that happen from paper plan, for example? What is your guys' view? Do you guys come blazing and say, we're going to make you go to the next level, or do you give people the freedom to continue on there?
So yeah, I don't think that's valid. I think like a good mentor and advisor is more valuable than that in the early days. And I think that they're going to have more skin in the game, so their money is probably more valuable anyway. When we were pipsqueaks when we started, right? And like we had to figure out a way to demonstrate that we could add value to even have a sniff at participating. And so like the first thing we would do is just try commercialize, right? And basically for free. Like, could we create value here and build a relationship and actually demonstrate that we would be valuable partners? And, I think for a long time, like some of our portfolio companies didn't even list us as investors. And now that, we've enjoyed like some success, like now we're like at the top of the list, you know? And you're like, oh, come on, guys, man. But I think it's important that you identify teams that are going to grow with you and that share similar ambitions, right? I think you have to get lucky, and there's so many variables, and but I think hard work does like really pay off in this space. And if you identify people who align with you, that you enjoy working with, that add value to what you're doing and are willing to contribute something, like those are the best kind of partners. And they don't have to be a VC. If they are a VC, so be it. But the last thing you want to do is take small amounts of money from like a bigger VC, right? It's just unimportant. And you're going to have to be reporting because they've got LPs or shareholders to be reporting to. And and it's going to suck up your time, and they're going to put pressure on you for your next rate. You become a professional fundraiser, right? And that's not necessarily healthy for a business. Like, what's healthy for a business is to be leading a founder-led team, and building this product and bringing in the skill sets that you need to compensate what you're doing. So, for example, aerobotics, right? Won a really big piece of work. Trees started flying in, and there were operational concerns, right? It's like, we've never had this much data to process. What do we do? Immediately we needed to augment, so we got some of the Uber team in, right? And they like fixed this very quickly. Like, these guys do operations, right? So all of a sudden we had like this massive like data capture team and guys that were actually processing. And we could scale that back once we had kind of met what we needed to do. And for the first time, we had operationalized to scale. And it was like a massive thing to rally around, because it meant now all of a sudden, we went from having done well in South Africa to be able to do well anywhere, right? With competitive advantage. That's pretty cool. So
on that subject, it's the same question. And you touched on this earlier around what VCs want. So what do you do when you're at a point going, okay, well, I need to spend time building this and growing it, and there's so much on the plate that there's no shortage of work, but I also need some funding to make that happen. But I can't do both at the same time. So as a VC, you get to go, cool, I know you're busy. What are the things that a startup should give me that would give me enough attention to have a look at you versus 42 pages of a 5-year cash flow, etc.?
Yeah, so
what would be the minimum that would get you to?
So if this situation happened like tomorrow, and you hadn't built a relationship with the investors, like, good luck. It's going to be difficult to access funds. I mean, nobody's going to just contribute funds. But if you've built a relationship and you come with signed contracts and you need funds to operationalize, even if it's just on a project basis, you're going to be able to access funds, right?
So are you suggesting even on that lower levels?
Yeah, absolutely. I mean,
because what you want to do is you want to create an opportunity or product, right? There's an opportunity you're trying to pursue. Now, if you go cold into a VC that might want to fund you, it's not going to happen. So it's like a marriage. It's a long-term build-up relationship with the VC and the investment community. They all talk together. And when you can explain that opportunity, it's not going to be a 20-pager or a cash flow analysis. It's going to be, okay, great opportunity. We trust you. We've invested in you, something like that, yeah? So,
entrepreneurs solve problems, right? And so one of the biggest lessons I had in like being on corporate and the other side was, like teams that did the work for the corporate side, like they cruised through, right? Like, they gave them the business cases, they did everything, they made sure they aligned to the strategic imperatives. If there was an event, they operationalized it, and they just removed all the friction in the corporate system. And I think a lot of teams like submit like a document and then wait, right? And in a corporate process, there's reporting, it's a slow process. And that's just not the right way to do anything, right? It's like, are you the moth or are you the flame? There's a big difference. Yeah. So there was a question there. Sorry.
Hi, Stuart.
How's it?
So one of the things you mentioned was the whole marriage. I think it's a common phrase that you're an investor and the startup, it's kind of like a marriage. So people playing ventures, is there like specific verticals that you're more interested in, that you feel you can actually add more value to? Because from a startup's perspective, you don't just, like you said, money's not all the same. You want an investor to come on board that can actually help you grow that business. Like, I think you guys invested in websites very recently, like retail and consumer behavior. They're like, where do you feel people playing ventures can add the most value to, like those specific types of startups?
Yeah, so one, if we can leverage our infrastructure assets. Two, if we think that this analytics platform could become like an industry platform, and there needs to be like a mindset shift. So we need to position early, right? So in farming right now, people rely on proxies like sensors in the ground. And it's because that's where the technology was at. But with computer vision and machine learning, you can actually compute the productive asset, and you can see through it with different spectrums of light. So this is a step change, right? But it requires a massive paradigm shift over time in the industry to recognize that. And as we see it like kind of going like popcorn, we get involved and we drive that. Because if we're computing that productive asset and we can better manage it over a longer period of time, we're going to improve yield and we're going to prevent pests and disease. And so that deeply interests us because this is applicable globally. There are millions and millions and millions of hectares to solve this for. And every single farmer has the same problem. And this same information can work for adjacent and supporting industries, right? Like a bank, like with Nedbank. And for us, that's very interesting.
No.
0 to 1 type of initiatives, but impact. There's the ones that have actually a bigger impact as opposed to a faster turnaround to get to an exit.
Yeah, well, no, so we don't necessarily want to go to an exit. We want to create platforms in industry that become very cash rich. And I think a difference that we have is we're not a fund, we're a permanent capital vehicle. So we don't have those artificial timelines. We're in this for the long game, and we want to be the SoftBank of Africa. Yeah.
Cool.
Can you just explain what you mean by that?
Which part?
That you are more of a long-term.
Oh, long term.
How's the actual structure set up?
So we want to go through with teams. We're not interested necessarily in teams that want to flip or sell out right now. We're interested in teams that want to become a platform in an industry, right? And that's a decade or two's work, right? Plus. And we're willing to support and are stage agnostic. So we can write small checks, and we can also write some of the largest checks that you will see in this space. And we want to participate in that entire journey, and we want to build up to like a strong minority, 20%, and create the right incentives and align the teams to go on to build these cash generative businesses. And that's our sweet spot, and where our track record is and what we want to grow out. And we believe there's a massive opportunity to do it, and it's not being serviced. Or underserved.
Hi, my name is
So
James.
there was a the first question was here.
No,
Sorry.
fine, ladies first.
Sorry.
Nothing to do with ladies. So, my question is actually also related to exits, because this is something I keep hearing come up, like an exit is essential, an exit strategy is essential, an exit strategy is essential, but no one exited from Amazon, no one exited from Google. Why is an exit strategy so essential? Why can I not have the vision to build a company that's going to last, that's going to make a
So an exit strategy doesn't have to be like an event where you clear out all the shareholders. An exit event can be a larger round where this investor was right for you then, they want to take money off the table, so you clear them out a bit with the right partner at that time in your stage. Or it can be listing. I think that's right now more applicable in other parts of the world than it is here. But there's absolutely nothing wrong in terms of stating that's what you're keen to do. It doesn't have to be like the entire thesis of your investment, because there are so many things that are going to happen between now and then. But it is important that a team that you're backing are sophisticated enough to be thinking about these types of things. And also to recognize that if a fund has an artificial timeline, they're going to need a liquidity event to return money to their to their LPs.
Good point.
Which is important, right? Also, investment teams, they want to build track record. They want to be able to demonstrate IRR, or internal rate of return, to their shareholders or to potential investors.
That doesn't happen with just dividends.
Yeah. So if you build a good dividends business, that's fantastic. But typically in like earlier stage technology companies, everything's being plowed back into growth. So it really just sits as an investment. And sometimes taking some money off the table, it depends the signal that it sends. Sometimes it sends a signal of the original shareholders think that this thing's running out of steam, or they don't back it as much anymore. Or sometimes it sends a signal of, the management team have had a discussion with that investor. They're not the right investor anymore. They're willing to sell at a discount, and they want to take on new investors, right? So it's the way you tell that story.
Okay. I want to just say thank you very much for to be here. Stuart will be with me outside. Then we can take further questions individually. Right. Cool. Awesome. Thanks.
Thanks, guys. Thank you. Thanks.